they didn't really care about or didn't really notice, anti-dilution or ratchets, whatever you want to call them, that come into play, where the round that they thought they did for 15% dilution, all of a sudden it goes to 25% dilution. And the investors that came in before them are all of a sudden scratching their head thinking, wait a minute, I don't own as much as this company either. So you're going to see companies that have done a lot of notes or done very creative financing or pre-IPO financing and these kind of things where they tend to get overstructured, they're going to be in trouble. So yeah, I hope that answers your question, but it's going to be a tough one, and what seemed I think everything that seemed sort of safe. I mean, nobody could have predicted this this sort of thing, and I think even folks who were saying, the market was getting a bit long in the tooth. We're due for a correction. Nobody thought it would be a global pandemic that was going to cause this, and I don't think we quite know how to deal with it yet.
Truly well said, Scott. I can't agree more with a lot of the statements you had mentioned. I really like how you methodologically, answered this question. That being said, when looking at certain funds, right, like for example, seed stage, early stage, pre-seed funds, up to later stage funds, how is it that these funds determine their multipliers or determine, what rate of return they're expected to get over a period of time?
Yeah, this is I think some of it is dark art, some of it is thumb in the air, some of it I think each fund does it differently, and then I think despite what the fund does, there's always a market that's telling you what the price is. So it's up to you to decide if that makes sense or not. But typically, it goes down to it should go down if you're want to be professional about it. It really goes down to how you want to construct your portfolio and how you want to diversify. So seed stage portfolios tend to be highly diversified. There's one or two standout investors that have kind of bucked that trend and done well. But I think that's not the norm. And the better funds at seed stage and the better performing funds tend to be diversified. And so if you look at that fund model, if you've got say 30 investments in a portfolio, or 40, or if you're 500 startups, you might have a lot more than that. You're looking for investments that I think what Peter Thiel calls the power law, where one or two investments will make up for any losses. You expect that not all of these companies are going to survive, and everybody's running their own scenarios about how many in a good market or bad market don't survive. But you're looking for one or two companies, and it's usually one company, surprisingly, that returns the whole fund. So seed investors tend to look for big companies with big TAMs, big market potential, and that becomes one of their core investment criteria. And so if you do have some zeros, if you're like I said, if you're investing in a company and at a 2 million post at a seed round, which if you're in Silicon Valley, you're probably, spitting your coffee out right now, but the markets in Southeast Asia are not quite as big as the market in the US. But to go from 2 to 10, or maybe in Silicon Valley terms, to go from 10 to 100 or 20 to 100, you're already at a 5x return. And so that's not where it starts or stops, right? That's just the next milestone. So I think the best seed investors, you're not looking for a base hit, and I think the data stacks up on that. There's been a lot of studies. I think Kaufman's got materials published on that. If you read Peter Thiel's book, or if you read the work that 500 Startups published, and most every other fund, I think, in the seed stage has compiled the data on it. Maybe we're all using the same data. I'm not sure, but but that tends to be how it goes. I think for later stage, it depends on where you stand, and really your cost of capital is really your price. If you solve back to everything, assuming your cash flows are the same, it's what am I bidding and what is my cost of capital, and it's not that apparent in seed investing. Nobody takes money thinking, okay, my cost of equity is 20,000% at the seed stage, because the investment terms are very friendly and it is equity, or it should be equity. I think there's some other models that people try to do, but there's a kind of a win-win situation. There's alignment there. As you get further along, and as you get to sort of E and F rounds, those investors are competing a bit differently, and the cost of equity has been historically cheap in that space. In a lot of cases, you're seeing private equity funds who have come back with, I think 30% is what they're underwriting, because they're not expecting any companies to fail, and they're not really expecting things to go down, right? They're looking at high growth companies, and maybe they're underwriting to a higher on it in a sort of bullish case, but their cost of equity is much cheaper in general. So that just means that assets get bid up, right? If your denominator gets smaller, then the value goes up. So that's kind of been the case in the past. I think we also have. Sure, I answered your question or not, but I guess that's kind of how it works. It's really a matter of your portfolio construction and what your investors are expecting. So typically, I think if you did the old back of envelope, the stock market returns 12%. I don't know if that's actually true, or if it's been true for a long time, but people want to see private returns to be higher than that because they're seen as less liquid. So that's, I think, where it all starts. Did I explain that? I just talk in circles here, but
no, Scott, you did a fantastic job of detailing that. So thank you for that insight. To wrap up the call here with one last question. In your journey you've had thus far in life, right? What is one piece of advice you would give to people who are looking, who are aspiring to be venture capitalists or up and coming entrepreneurs?
And you sent this a little bit ahead of time, this question, which I really appreciate, because it's one of those things you think you could think on it longer and come up with a better answer. I'm sure as soon as this is published, I'll think of something better. But I think the things that I constantly look at myself and try to improve on, and the things that have really helped me along. The first thing is, I think, having a mentor and having multiple mentors. That is probably the biggest asset you can have, and they don't cost anything. You may have multiple mentors. Maybe you have a mentor for your family life. That sort of uncle or friend of your family that just has a real steady head and really understands the challenges and it can help you through your personal life and your love life and that kind of stuff. And the same for parts of your business life. And so surround yourself by good people and try to cultivate those, because it's not easy to do, and you have to really give a lot to those relationships to get the most out of them. It's not going to be the mentor that you get in your first job and they say, okay, this guy is your mentor, and now that's your mentor. It's going to be a much more personal relationship. So those can also blossom quite well. The second thing I would say is almost the same thing, is just work with the people that you love and love the people you work with. If you don't have that, your life might be pretty miserable. We work now, I think 12, 14 hours a day. And that's just how everybody's working these days. And even if if you're not sitting in an office for 14 hours, you've got your office in your pocket, and you're going to be getting messages from these folks, and you're going to be sending messages to them, and have to navigate a lot of things with them together. So try to as best you can. It's not always in your control, but you try to put yourself in those kind of situations that you work with people you love, and also just show love to people you work with. I have a daughter now. She's a little more than a year old, and it's just amazing. Kids, they just don't remember anything, and I think sometimes we don't forget enough when we're dealing with people that we should just be constantly showing them love. And the last one, I think, is a bit more broad or more hard-nosed, is when you look at opportunities, look for alignment. I think the biggest sort of failures, or when I look back at things, you say, oh, that should have worked out. That was such a no-brainer. Why didn't it work out? 9 times out of 10 in my life, it seems like it's because there wasn't alignment, or some of the people involved, some of the key people involved, just weren't really bought into it. And so having that alignment and making sure everyone's bought into it, that's really what drives things forward. And that takes a lot of work too. But that's really what I look for, is that people really, or projects that everybody is fully committed and running in the same direction. So that's my advice.
Scott, thank you for that insight. If people wanted to reach out to you to get to learn more about you in 1982 Ventures, what would be the best point of contact?
Sure. Well, we'd love for people to reach out. The first port of call is probably our website, 1982.vc, 1982.vc. You can email me directly, scott@1982.vc is a great way. I'm pretty active on LinkedIn. You can message me there, though I get a lot of stuff there, so sometimes that comes a little bit behind. I think those are probably two of the best ways. But yeah, look forward to hearing comments back, people sharing thoughts, sharing their projects. We always say, kind of come to us early. We like to be early. We want to build relationships. So yeah, definitely reach out to us.
Thank you, Scott. It was a pleasure having you on Geeks of the Valley.
Yeah, really appreciate the opportunity to share a story and be a part of Geeks of the Valley.